sometimes as a lender, and this is not always going to be the case, but sometimes a lender, when they're like looking at new loans, or looking at collateral value, things like that, will look at what's the book value of the assets on the balance sheet. And in theory, that tells them whether those assets have any real value for collateral purposes, so they can lend against them. And there might be some assets that hold their value, no matter how much they've been depreciated. But it's still a way, it's something that a lender would look at too.
You don't depreciate land. Land goes, I believe, again, I'm not an accountant, but I believe land goes on the books and it stays at the value you purchased it. Now, why they chose land to not depreciate, I don't know, but that's the way it works. But, you know, I know people in Door County who bought land and it went on their books at $10,000 because that's what it was worth back in the early 60s, and we know it's on the bay, and we know it's a lot more today. It still says $10,000, whatever my example was. It's the way the accounting is done. It's the way the rules work. Okay? Now let's take a look at the balance sheet. Look at the balance sheet. Okay. The balance sheet, here's the construction of the balance sheet. This is the one that I see people kind of stay away from sometimes. It's once you get comfortable with it, it's really easy. You'll say like, oh, how come I didn't get this before? You know, this isn't hard. But it was for me. There was a time where I didn't look at my balance sheet because I didn't understand it. So I didn't look at it. It's an important report to understand. So it's a snapshot of the firm's wealth and how it's funded that wealth. That's kind of what it is. Okay. Here's what I want you to get out of this. A couple things let's just take from this. This is what a balance sheet looks like, what you see up here. Okay? Now, you know, there's stuff in here, so it's going to get longer, but it's got these sections. So we have a section called assets. Let's just look at that. A section called assets. We have a section called liabilities. We have a section called equity. So there's 3 chunks to a balance sheet. 3 chunks. I want you to see a couple other things. I want you to see, oh, here's the word current. Here's the word current. You'll see that in balance sheets. Oh, that's interesting. What the heck is a current asset? Current liability. What's current mean? And then you see long term. It's like a current long term. Current long term. See, there's a pattern there. And sometimes instead of long term, you'll see the word fixed. So some fixed assets, long term assets. Okay, same thing. We'll define it this way. I don't think I can find it on another page, so I'll do it right here for you. Anytime you see the word current, anytime you see the word current on a balance sheet, tell yourself 12 months or less, 1 year or less. Okay? And I do define, no, don't write it down, it's on another slide. And it's coming up. You don't have to write it down. We'll cover it on 2 slides from now. We promise you. I'm saving you pencil time. Let me define that in just a second. So we got assets. Okay, assets is stuff we have. Stuff we have. Could be cash, could be trucks, could be buildings, could be patents, it's just stuff we have. Stuff we have. That's what assets are. Cash, accounts, oh, by the way, accounts receivable. What's an account receivable? It's an IOU, right? It's an IOU. The customer says, I owe you some money. You made me something and I haven't paid you yet. I owe you. That's our receivables. So stuff we have are IOUs, accounts receivable. Plant, buildings, equipment, inventory. Right? It's stuff we use in our business. That's what assets are. Now, let's look at liabilities. Liabilities, now we're into a section, liabilities and equity, is kind of how did I get the stuff I have? How did I get it? Well, or in other words, kind of how did I pay for it? Is not how did I get it, I drove a truck to get it. How did I pay for it is the real question. When you see the word liabilities, just an easy rule of thumb, think debt. Debt. Liabilities equals debt. So what you'll see in liabilities are loans that you have. It could be loans to banks, it could be loans to the advanced microloan program, it could be loans to yourself as a shareholder, loan to shareholder. You may have loaned your own business money, but just think of it as debt. That's where I list my debt. Okay? And it's where I borrowed money in order to get some stuff. Okay? And then there's equity. And equity is kind of it's what I get to count as my own. It's my own money, it's the portion that I get to say is mine. So in my example of the $100,000 house, the house is the asset, The mortgage is a liability, and my 20% that, maybe I paid out, but I get to call it equity. It's my chunk of the stuff I've got. Okay? So it's a real simple concept. And we just look at a bank just like we look at our house. The asset, any liability, anything we owe someone for acquiring that asset, and then our portion of it. Okay, now I get to do these. I like these two terms. Current, 1 year or less. Now, current, think of it as it's going to turn into cash in 1 year or less. Turn into cash kind of in 1 year or less. So cash, accounts receivable, inventory. Wouldn't I hope my inventory turns into cash in 1 year or less? I hope sooner than 1 year. I hope the dress I bought and put on my showroom floor gets sold within a year, or the steel I bought gets turned into a widget or a car or something within a year. So think of current as 1 year or less. Think of long-term as greater than 1 year. Okay, so if I bought a truck, or I bought a machine, or I bought a building, it's something I have, it's stuff I have, but I don't expect to turn that into cash, and I'm not going to sell it in 1 year. I wouldn't anticipate that. So we put it would be a long-term asset. Okay? But my inventory would be a short-term or a current asset. My accounts receivable, the IOUs, they have value. I hope those IOUs get paid within a year. I wouldn't want to have to wait that long for somebody to pay me. Okay? Right. Sometimes you'll see a term paid in capital or common stock. Terms you'll see down in the equity section. That's your contribution to the business. That's your investment in the business. So when Laura said, we expect people to put 10 or 20% down on a loan, and that's kind of your investment, that 10 or 20%. Okay, that's paid in capital to a business. You'll see a term down here called retained earnings. This gets people tripped up, because I'll tell you in a minute why. Retained earnings, that's the profits, the cumulative profit since you started your business. So I had $10,000 of profits last year. I've got $10,000 of retained earnings this year. Okay? Now here's where people kind of get tripped up. They say, well, where is it though? I'm looking for it. I can't find my retained earnings. And bingo, that's where it is. That's exactly where it is. What did I do with my profit? Hey, maybe it's in the bank account in the form of cash. Maybe I bought a truck with it, and it's sitting over there in the garage. Maybe I bought a machine. Maybe I did. So my retained earnings, you want to know where your retained earnings are? Go look up in your assets, in the stuff that you have. That's where retained earnings lives, in a tangible form. Okay? And so that you can really impress your friends at the next cocktail party you go to, you can, and by the way, they will be impressed when you tell them your little accounting knowledge. That will go a long way. Yeah? When you look at a balance sheet, this is trivia. When you look at a balance sheet, and it says cash, and accounts receivable, and marketable securities, and inventory, they're listed in order of liquidity. Oh, that's not interesting. You know what liquidity is? You hear that term? Liquidity means the ease of which I can convert something to cash. Okay? Well, cash is already cash. That'd be the top of the list, right? It already is what I want it to be. Next one down, maybe accounts receivable. That's pretty easy to convert to cash as long as I can get my customers to pay me. Okay? Maybe the third one is inventory. Now, that's a little harder to convert to cash. I have to make something with it, or I have to get it sold. Okay? So they'd be ordered that way. So that is nothing of any more significant value than a piece of trivia you can use to impress your neighbors and friends.